Ticker symbol CAT is down over 4% in the past year. And today we'll be looking at a clear market leader with a growing dividend, which is mainly down because it has uncertain future prospects. But in the past year, its net income has grown by over 4% and it has faced consecutive quarters with net margin expansion. So today we'll be looking at none other than Caterpillar, a heavy-duty machinery company. In their annual report, they state that they're the world's leading manufacturer of construction and mining equipment, industrial gas turbines, and diesel-electric locomotives. And honestly, I don't think this company needs a lot of introduction, because just by looking at the picture, I'm sure you've seen machines like that, in that bright yellow with those logos, everywhere in the world. Whenever you're going near a construction site, chances are the machines used are going to be from Caterpillar, because they're simply the market leader and the providers of the highest quality and most reliable machines that you can find in the market. They currently divide their offerings into different segments, which are construction industries, where they provide all these machinery for building, then resource industries, where they provide similar machines but for mining, then they have the energy and transportation sector, and finally their financial products, where they basically offer leasing and financial services to allow their clients to purchase their machines. Now, in order for Caterpillar to sell their machines, what they have is a worldwide dealer network in over 191 countries with different distributors who are responsible for finding and selling to clients. However, in Japan, it is the only country where they own a dealership that covers over 80% of the Japanese market. And what I like about this company is that it's extremely transparent, and in their annual report, it breaks down their growth strategy into 3 different parts. The first one being their expanded offerings, where they want to develop new products by collaborating and by listening to their active clients, so that they're not only able to understand their needs, but they're also able to meet and fulfill their requirements as best as possible. Number 2 is that they want to focus on improving their operational excellence. They want to focus on a lot of different areas, but the first ones that they mention is that they want to keep improving employee safety, they want to keep focusing on lean production and automation in order to reduce their costs of production, they want to strengthen their supplier relationships in order to keep getting those high quality materials at a very competitive price. And last but not least, they want to focus on growing their services. These services, we could think about them as everything Caterpillar sells to their clients once they have already purchased a machinery or some equipment. For example, they have mobile applications and other trackers, which allows you to keep track of the status of the different Caterpillar machines that you have. And once these become slower or present some faulty behavior, the client immediately gets a notification in order to book maintenance for that specific machine, which allows these machines to extend their useful life and be a lot more useful to their new clients. And one thing that I did not expect about a company which provides heavy-duty machinery is for their financials to look this good. They have a 25% return on capital employed, and for you to just put this into perspective, our threshold is a 15%. Caterpillar has a 30 times interest coverage ratio, which means that they don't have to worry about debt anytime soon, and they have a 73% cash conversion ratio, which is under our threshold of 80%. However, they have a gross margin of 36% and a net margin of over 17%, which is again over our threshold of 15%. When we look at their financial analysis, we can see that all 3 important metrics, their revenue, their gross profit, and their net income, are extremely stable, very predictable, and very consistent. All of these metrics had been growing up until September 2023, and since then their revenue has started to drop slightly quarter after quarter. Now, this mainly has to do with the rising uncertainty that there is in the world, where a lot of these companies just start to delay the way that they will buy these machinery and just delay construction and mining projects altogether. However, if we look at the bottom line of this company, this hasn't really had an impact, as even though their revenues have declined, their net margin has expanded for the last quarters, which means that its gross profit and net income have stayed pretty consistent. And when we look at their efficiency ratios, since these are generally more closely linked to their net income, we can see that they have also been extremely consistent and they have been rising quarter after quarter, with the return on invested capital, which is the value that we like to focus on, sitting just under 20%. And finally, when we look at their balance sheet, we can see that this company is basically the definition of predictability. Their total assets have been above their total liabilities for a very long time, and we can see that their current ratio has been very consistent for the past 10 years. Which is great, as it allows this company to give a lot more confidence to investors in that it is being run in a very sound way. And now when we look at their fundamental analysis, this company almost gets the perfect score, scoring a 7.5 out of 8 ticks. Starting off with their low liability risk, where, as we saw from their interest coverage ratio, they don't have to worry about debt anytime soon. But you can add to this the fact that it has a very solid balance sheet, as it can pay all of its short-term liabilities only by using its current assets. Then, this company, as expected, is extremely consistent at generating cash flows, which are growing quarter after quarter thanks to that net margin expansion, and it's not really being helped by their organic revenue growth. And I gave a half a point here because although the revenue has not been growing quarter after quarter, when we look at a year-over-year view for the past 3-4 years, it has been growing consistently. Additionally, as we will see in the next slides, this company pays a very solid dividend, which is extremely stable, has been there for a very long time, and is growing year after year. And additionally, they use all of the remaining free cash flow that they haven't used in either paying out dividends or reinvesting back into the business to conduct share buyback programs, which allows the company to generate a lot more value for the investors. And last but not least, we have the two most important factors that we like to look at, which is first their pricing power, and second of all their existing moat or competitive advantage. In my opinion, Caterpillar meets them both. We define pricing power as the ability of increasing your prices year after year at a rate that is above inflation without losing many clients. And when you think of Caterpillar machines, well, these are the best of the best. When you think of heavy-duty machinery and you think about price to quality, these are the number one machines that will pop up to your head. And when you're working in a field like construction or like mining, the two main expenses you will have are, first of all, materials, but number two, heavy-duty machinery. And that is something that you cannot risk sparing on, because if you get a low-quality machine, you will face a lot of problems, you will delay the construction, will not meet your timeline, which means that you will get paid less, or the overall quality of the structure or of the building or of the mine that you're working on will be heavily impacted. So this is why a lot of these companies actually don't like taking the risks, and they will go for Caterpillar and they will stick to Caterpillar machines regardless of the price rising above inflation. This basically goes hand in hand with their existing moat or competitive advantage. It is the leader in market share, and there is no wonder why. There are companies with more specialized offerings. There are companies with cheaper offerings, but Caterpillar is the one that is able to provide the widest portfolio breadth, meaning the widest availability of machines, and with the best image out there, where you know that just by buying this company's machinery, you won't mess up, because they have a very high satisfaction rate, a very large percentage of returning clients, and score highly on all of the different quality assessments that are conducted for heavy-duty machinery. So when you're the decision maker for a construction company or a mining company, if you choose Caterpillar, nobody's going to judge your decision, and it's basically an insurance that the project will go smoothly. Now, these are the dividends that I was talking about. They currently have a 1.66% dividend yield with an acceptable 25% payout ratio. This means that they have a lot of room in case that things go south or in case that they want to keep increasing their dividends for a very long time. However, it does look like this dividend yield is at the lowest point where it has been in the past 5 years. But when we look at their valuation analysis, we can see that in terms of their historic price to earnings ratio, it looks like this company is currently trading at the average where it has been trading for the past 3 years. And when we look at their free cash flow yield of 5.6%, it is way above the long-term inflation rate of 3%, which suggests that this company may be undervalued at current prices. Now, when we look at the risk and possible challenges, the two main ones that I see is the worsening of the competitive landscape, where there are a lot of new competitors entering the space. As I stated, there are some that are very specialized in different machinery, and there are some which offer very cheap prices. I don't think that this is a significant risk for Caterpillar, which is why it's only a 40%. It's a risk that we do have to consider in case that construction companies or mining companies decide to go for more specialized or cheaper alternatives in case of the old, reliable, well-known Caterpillar company. And the second risk, which is more significant, is the risk of economic downturn or cyclicality, because both these sectors, mining and construction, are extremely cyclical. They work best and they work more when the economy is booming. And whenever there is a recession, they do tend to slow down quite significantly, which normally means that they will invest a lot less into Caterpillar machinery, hence their revenues will drop during these times. Now, before we move on, please remember that I'm not a financial advisor and this is not financial advice. However, I do believe that this company has a great moat, it produces consistent cash flows which are very predictable, and it has high return on capital employed, meaning that it knows how to create value for the investor. So I do believe that this is a good company and it can be a good investment, especially if they can reaccelerate their revenue growth. As always, thank you for watching. This has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.